Welcome to the MaxDividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see step by step whether it really deserves a spot in a serious dividend portfolio. Today we're examining RPM International Inc., ticker RPM, a global leader in specialty coatings, sealants, roofing systems, and building materials embedded in construction, maintenance, and infrastructure protection worldwide. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the MaxDividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if RPM is attractively priced today. How this company makes money. First question. Do I clearly understand how RPM International earns its money, and does that business model make sense for dividend investing? RPM generates revenue through a diversified specialty materials model, formulating, manufacturing, and distributing high-performance coatings, sealants, roofing systems, flooring solutions, and restoration products used in construction, maintenance, and infrastructure projects worldwide. Cash flow is driven by recurring maintenance and repair demand tied to long asset life cycles, not by short-term construction booms or consumer discretionary trends. The core earnings drivers are Construction Products Group, waterproofing systems, sealants, roofing products, and concrete admixtures primarily used in commercial and infrastructure projects, with recurring demand linked to repair and renovation activity rather than only new construction. Performance Coatings Group, corrosion control coatings, flooring systems, and fireproofing materials for industrial facilities and infrastructure assets, where durability and regulatory compliance support steady long-term demand. Consumer Group, specialty paints, coatings, and restoration products sold through retail channels under well-recognized brands, adding diversification across professional and do-it-yourself demand. Specialty Products Group, niche, high-performance solutions for unique industrial and restoration needs, further broadening RPM's exposure across end markets. In other words, RPM sits at the center of global maintenance, repair, and protection cycles, supplying products embedded in the preservation of critical structures where performance directly affects asset value and operational continuity. Exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple, at least 15 years of consistent dividend growth. RPM International doesn't just clear that bar, it obliterates it, with 52 consecutive years of dividend increases that rank it among the most durable dividend compounders in the specialty materials sector. Annual dividend per share rose from roughly 85 cents 15 years ago to approximately $2.07 most recently, with no visible reset or panic cut. For a company exposed to raw material cost volatility, construction cycles, and industrial production trends, that consistency points to durable cash generation and a management culture that treats the dividend as a standing commitment. Step 1 passed. RPM International behaves like a genuine dividend eagle, with 52 consecutive years of increases that have persisted through multiple economic cycles. Step 2. 5-pillar secret formula. First pillar. Sales growth, the foundation. Over the past decade, RPM International's revenue increased from roughly $4.8 billion to approximately $7.3 billion. Growth has been supported by its broad portfolio of specialty brands, exposure to maintenance and repair activity, strategic acquisitions, and operational improvement initiatives, not dependent on a single end market or a temporary spike in demand. Its positioning in infrastructure protection, waterproofing, roofing, flooring, and corrosion control provides recurring demand tied to long asset life cycles. Sales growth past. RPM's steady long-term revenue expansion reinforces its case as a diversified specialty solutions platform with a durable foundation for continued dividend growth. Second pillar, profit growth, the fuel. Over the past decade, profit grew from roughly $2.1 billion to just above $3.0 billion. RPM benefits from established specialty brands with pricing power in niche markets, long-term relationships with professional contractors, and exposure to maintenance activity that supports recurring demand. Ongoing operational improvement and disciplined cost management have helped translate revenue growth into stronger profitability. Profit growth past. RPM's expanding earnings base strengthens the foundation of its dividend and supports long-term capacity for continued growth. Third pillar, net income, true strength. Over the past decade, net income increased from roughly $350 million to approximately $680 million, with some year-to-year variability but a clear upward trajectory. That stability is rooted in the essential nature of RPM's products. The need to preserve and extend the life of critical assets does not disappear during slower economic periods, supporting consistent profitability across the cycle. Net income past. RPM demonstrates a resilient earnings profile with a decade-long pattern of overall growth. Fourth pillar, dividend payout safety, protecting passive income. RPM's payout ratio started at an elevated level, reaching close to 90% at the beginning of the observed period. Over the past 6 years, management has meaningfully reduced it to a range of roughly 40% to 45%, reflecting stronger earnings growth and more balanced capital allocation. The company improved both flexibility and sustainability while continuing to raise the dividend annually. Dividend payout safety past. RPM has successfully reduced its payout ratio from previously elevated levels to a more prudent range, reinforcing confidence that the dividend is well supported. Fifth pillar, debt burden, avoiding traps. Over the past decade, RPM's debt ratio fluctuated within a moderate range, generally between approximately 0.60 and 0.75, before declining toward roughly 0.62 most recently. The pattern suggests a company that has maintained control of its balance sheet while continuing to grow, avoiding excessive leverage expansion and gradually improving financial flexibility. Debt burden past. RPM's leverage appears reasonable and contained, supporting confidence that the dividend rests on a stable and responsibly managed balance sheet. RPM International's overall financial score comes in at 98, very safe in our framework, signaling strong financial stability and the kind of long-term consistency dividend investors value when building portfolios designed to compound income over many years. Does it fit our plan? MaxRatio combines current dividend yield, dividend growth, and financial strength to classify stocks as growth eagles, balanced eagles, or income eagles. RPM International's MaxRatio is 3.71, placing it in the growth eagle bucket. With a dividend yield of 1.94%, RPM is not a high-yield play today. The appeal is in its growth profile: 42% cumulative dividend growth over 5 years, a payout ratio improved from near 90% to the 40 to 45% range, and 52 consecutive years of increases, reflecting a deep long-term commitment to shareholders. RPM fits investors who prioritize consistency and long-term income expansion over a high starting yield, combining a reliable current payout with a proven ability to grow it over time. Is the stock undervalued today? Here the signals are broadly supportive. Versus peers, RPM screens as undervalued in the MaxDividends research platform, suggesting the market may not be fully recognizing RPM's earnings resilience and long dividend track record compared with similar businesses in the specialty materials and coatings sector. Versus its own history, RPM has generally traded at an average PE of approximately 24 to 25 over the past decade. Today, the stock trades near 21 times earnings, modestly below its long-term historical average, meaning investors are currently paying slightly less for each dollar of RPM's earnings than the market has typically assigned. On yield, RPM pays about 1.94% today versus a longer-term average near 2.08%, slightly below its historical norm, meaning the dividend keeps growing, but share price appreciation has modestly outpaced dividend growth relative to historical levels. Analyst consensus sees meaningful upside, with a 12-month consensus price target implying roughly 14.93% upside, and an overall lean towards strong buy, suggesting the investment case is supported by both business quality and potential for reasonable price appreciation. Final decision. RPM International is a high-quality specialty solutions platform with 52 years of dividend increases, improving payout discipline, and a business model rooted in recurring maintenance and infrastructure demand. It screens as undervalued versus peers, trades slightly below its own long-run average multiple, and offers analyst-backed upside, a constructive overall setup for a growth eagle compounder. For dividend investors, RPM makes the most sense as a long-horizon holding. A 1.94% starting yield paired with 5 decades of consistent increases and the potential for that payout to keep rising as earnings grow, and the improved payout ratio creates additional headroom. The key watch items are construction cycle exposure, raw material cost volatility, and whether earnings growth can continue to support the valuation. Subscribe for more analysis. This is not investment advice.